Welcome to the Benson Wealth Podcast. I take complex financial and economic topics and make it accessible to the everyday listener. Hello, everyone, and welcome back to the Benson Wealth Podcast. My name is Drew Benson. I'm the president and founder of Benson Wealth Management, and I'm a senior wealth advisor with Raymond James. I'm also the co-managing partner for True North Wealth Management Group, which is a platform for independent wealth advisors. I'm a former macroeconomist, and currently I'm a certified financial planner and wealth advisor. Okay, so there's been a lot of news, and today I'm going to switch it up and do a solo episode, which I haven't done for quite some time. You've probably gotten pretty accustomed to my interviews. We have a lot still on the docket in terms of interviews, some great ones coming out. So you'll still see a lot of those over the next few weeks. But we did want to change it up today because a lot has happened with the economy. And the big news is that the Fed has lowered rates by 50 basis points. So let's start there. So a couple weeks ago, the Fed decided to finally lower interest rates, which, by the way, if you go back in time, a lot of people expected the Fed to lower rates back in March. And that did not happen. In fact, I said the following at the beginning of the year. Still think that inflation will be stickier. So there's some folks in the industry that believe that inflation will fall to the target at 2% and even possibly could fall below the target. I actually was just on a phone call with an investment firm that they're forecasting that inflation, believe it or not, could fall below 2%, which is pretty wild to think about. I'm not as sanguine, so I have a harder time believing that inflation would actually get all the way down to, say, 2%. I see maybe inflation hovering closer to 2.5%, but I don't know if we get back to the target. And because I think it's going to be a little bit longer and inflation will be a little bit stickier, that's where I'm not as sanguine about the Fed cutting rates in the first half of the year. There is some discussion that the Fed may cut rates in the first half of the year. I'm more inclined to believe that we would see rate cuts maybe in the second half of the year, the third quarter. And while I think it's probably more. So one of the reasons why I think people were way too early in expecting rates to come down is that they just underestimated the amount of money that we injected into the economy. And I think from the beginning until today, people did not fully. I don't think there was a full appreciation for just how much money was sloshing around in the system. And I felt in my gut that this is going to take longer than March of 2024 for inflation to come down enough for the Fed to feel confident enough to actually start to lower rates. But we finally did it. So the good news is it's here. The Fed has lowered rates by 0.5%. And just a couple important points for you to know as an investor. One is both the equity and the bond markets tend to do excellent when the Fed lowers rates, unless they're lowering rates because we're falling into a recession, which we're not, and we'll talk about that today. But typically when the Fed starts to lower rates, that's usually a boost to the stock market. And it's really simple, and I've talked about this at length on this podcast, that if borrowing costs are elevated because the Fed raised interest rates, if costs are way high, that's going to create additional costs. That's going to pull money out of the system. If you're spending more on your mortgage, if you're spending more on your car payment, if you're a business and your interest rates on your business loans are significantly higher, that means there's less disposable money in the system, and that means that the economy can fall into a recession. The good news, and I'm very thankful that the Fed finally did this, is they started to lower rates. And I've talked about this as well. I think there can be significant lag effects to Fed policy. So when the Fed was super late to lower or to raise rates, they missed an opportunity to really pull inflation down. So I think the Fed was late to the party. And my fear this time is that the Fed would also be late to the party. And I've written about this on my blog if you want to read more. But I think an argument could have been made that the Fed could have kept rates higher. The problem, though, is that there's such a lag effect to the way the Fed does policy that they need to get ahead of it now so that they can avoid the big recession. And I do think, believe it or not, that there's a possibility of a soft landing because of the way the Fed is doing policy right now. So what does that mean for you as an investor? That means that the stock market will likely do well in this environment. Historically speaking, when the Fed is in a rate decline, when they start to lower rates in that cycle, what you'll see is that equities tend to be up double digits over the next 12 months. That's sort of an average figure. And then if you look at bond prices, same deal. Like bonds can actually go up. The underlying value of the bond can actually increase quite a bit in value when the Fed starts to lower rates. Now, we don't know exactly how much they'll lower rates through the end of the year. Some people are predicting that the rates could decline by basically 200 basis points, which is 2 full percentage points from this point on. And if that happens, by the way, an old rule of thumb is if you have, say, a 5-year high-quality bond and rates go down by 1%, the bond itself will actually appreciate by 5%. Okay, so like I said, if it's a 5-year bond and rates are down, that's 5% increase in the value. That's what a typical bond fund, by the way, that's what the typical duration is. You know, your everyday bond fund that you'll see in a lot of 401ks and a lot of IRAs. Some of them are longer term. You can get ones that are way longer than 5 years, but on average, I tend to see it around that mark. And so if you're in kind of the classic high quality bond fund, assuming it's owning, you know, safer high quality bonds, we could be in an environment where, think about it, if the Fed lowers rates by 250 basis points from the start of a couple weeks ago until the end of next year, that's basically a 25% appreciation in the underlying value of a bond, right? Because if it's, that would be 15%. So what I'm saying is this could be really great for a bond investor. Now, I don't have a crystal ball. I don't know exactly what's going to happen, and maybe the Fed doesn't end up lowering rates as much as we think, but it typically bodes well for the bond market. Here's what I will tell you is even if it doesn't go up by 15%, I do think it's highly likely if you add in the yield you're getting from your bonds, and if you look at the potential for price appreciation on the actual bond itself, we are likely to see double-digit returns in the bond market as well as the equity markets. Now, here's the thing, though, that I just can't wrap my mind around is that so many people, though, if you look at a lot of articles, it's like everyone's talking about recession. When I flip open the Wall Street Journal, when I look at Barron's, when the screen next to me, when I turn on Bloomberg or Fox Business, it seems like all I'm reading about is recession. Seems like we're always at war with recession. And I worry that is really clouding investor expectations and it's clouding people's ability to make smart decisions with their money. And I've been really trying to figure out, well, why in the world are so many people predicting recession? And I've really come down to a determination that it's one thing, and that's the inverted yield curve. So if you're unfamiliar with the inverted yield curve historically has been one of the most powerful predictors of recession and has predicted, I guess, like 9 out of the last 10 recessions over the last several decades. And so it's a reliable thing. And by the way, the yield curve has been or was inverted for nearly 2 years, actually a little bit more than 2 years. So let me show you. So I'm going to share my screen here, and I want you to get a sense of what the inverted yield curve looks like. This is what the typical slope of a yield curve should look like, right? If you look at a bond, so this is the yield curve of a bond. So if you are willing to wait longer for a bond to mature, conceivably one would expect that you would get a better income or yield out of that bond. So I wouldn't want a 1 or 2 year bond that pays me more. Like I wouldn't want to buy a 10-year bond if a 2-year bond paid me more. So one would think that for the willingness to be very patient for the bond to mature, you should be incentivized somehow by just getting better income. So in a normal market, this is going to hold. The yield curve is going to slope upward and to the right, but sometimes it inverts. And this is what an inverted yield curve looks like. So this is where a shorter term bond, such as a 2-year treasury, will actually yield more than a 10-year treasury. Now you're probably wondering, like, why in the world? And let me unshare my screen here. Why in the world would an investor actually agree to get a 10-year bond that pays them less than a 2-year bond? Because I'm going to wait. If I'm going to wait 5 times the time frame, I better get paid more money. But the reason that occurs is that, there's a couple factors. Usually when the 10-year treasury goes down, it's because people are starting to become very fearful of recession. Now, here's a couple things. One is that if you look at a 2-year treasury, what economists have basically figured out and what financial experts have figured out is that the 2-year treasury is pretty much a reflection of exactly where Fed policy is right now. So the Fed raised rates by, going back to the very beginning, they were at 0. So they raised rates by over 5% on the discount window. So because they raised rates so much, we would expect that the 2-year treasury yield would also go up pretty dramatically, which it did. But the 10-year Treasury did not go up as much. And the reason the 10-year Treasury did not go up as much is because investors did not think that the Fed would keep rates higher for longer. Now, a lot of times the yield curve inverts is because people are actually terrified of a recession that's brewing on the horizon. And if you think about it, if you're worried about a recession, you want to buy as long of a term as a bond at the highest quality that you can get it, because you don't want your bond to mature in the middle of a recession. So what happens is the demand for 10-year treasuries grows, and because the demand grows for those 10-year treasuries, what happens is there's an inverse relationship, by the way, between the price of a bond and the yield of the bond. So if all the demand is spiking on a 10-year treasury, then you're going to see the yield come down. So when the yield curve inverts, as I was just describing to you, what that usually means is that people are super fearful of a recession and they start to price it in, which makes it very predictive in nature, which is why it's been a very reliable harbinger of bad things to come. And that's why people pay attention to it. But there's some serious problems with it. So the first one is an obvious one. The reason I think, by the way, we make this implicit assumption that if the yield curve inverts, it's going to be a recession. Well, yield curves have nothing to do with the economy. They don't cause anything. Right? We all know this implicitly, but I think there is an assumption that you see a data point, it usually means a certain thing, and therefore it's going to lead to that certain thing. A, therefore B. But that's not the case. In this instance, the Fed has basically been broadcasting from the beginning that they don't expect to keep rates super elevated for really long. You know, if you go back to what Powell was saying back at the beginning, towards the beginning of the rate hike cycle, actually, before the rate hike cycle, he thought inflation was going to be transitory, which didn't pan out. And so I think we were all under this assumption that the Fed was going to raise rates temporarily for a little bit, that rates would not remain that elevated, and then they would come back down. And that, by the way, ended up being a lot more extended than people expected, but it did come back down. And we're now on this rate decline cycle. So I really think it wasn't so much that investors were fearful and therefore the 10-year Treasury came down. It was more that people just didn't think the Fed would have the grit or the tenacity to actually keep rates elevated for as long as they did. I'm actually surprised that the Fed did do that. A few other problems with the inversion of a yield curve. So we talked about, listen, there's another explanation than just recession. So we can't assume just recession. Another thing is that you could have just a false signal. So, by the way, yield curves invert and then recessions don't happen, and there were 3 of them. So if you look at the Cleveland Fed actually did a study on this, and what they found is they said, quote, there are 2 notable false positives, an inversion in late 1966 and a very flat curve in 1998. And then I found this research from BNP Paribas out of France. They pointed out that the yield curve aggressively flattened and nearly inverted in 1994 after the Fed started raising rates, but a recession did not occur. So again, there can just be false positives. I think this is likely to be another false positive. A third component is, look, recessions happen with a degree of regularity. And sometimes yield curves invert, and it happens to coincide with a recession because recessions happen almost every 7 years. And I'll give you a really tangible example. In 2018, the yield curve inverted for 2 reasons. One is that it inverted because of growing trade wars that occurred with China. And the second reason the yield curve inverted was just geopolitical tensions that were starting to flare. And so there was fears that those things would, and a third and a big one is that the Fed was starting to raise rates. So with the Fed raising rates and then with the geopolitical tensions with trade wars, the big concern was, wow, this is going to trigger a recession. So they started to price the recession in by bidding that 10-year Treasury down, and thus we had an inversion. And guess what? We did end up having a recession in 2020. But we all know that the recession in 2020 had literally nothing to do with the 2 factors I just mentioned before. The recession in 2020 had to do with this exogenous shock, this exterior shock known as COVID-19. And oh, by the way, in 2019, the economy was extremely strong. So that is an example where, yes, the inverted yield curve was predictive of a recession in 2020, but it was just coincidental because we all know that had nothing to do with it. It all had to do with the fact that we essentially shut most economies down globally because of the pandemic. So I think that's really what's driving it. And at the end of the article, so I wrote this for my blog and I would encourage you to read it. But one of the things I also note is that the yield curve is really reflective of sentiments about the economy. And my argument is, why rely on sentiments about the economy when we can actually look at hard economic data? There's better data out there, in my opinion, that aren't just a measure of people's feelings in the moment, but are actually indicative of what's happening with the economy, and those are leading economic indicators. I will say this, though, if you look at a lot of leading economic indicators, they do include the inverted yield curve. I just think it's not necessary. And by the way, and I'll say this, and I said this in the article, when the yield curve inverts, it's often I think it's a redundancy. We already see, by the way, if the yield curve is inverting and the leading economic indicators, like housing starts, for instance, if those are all declining in tangent, then yeah, the inverted yield curve is probably a really, really helpful thing. But if the inverted yield curve occurs, but a lot of other leading economic indicators are positive, then my general take is then it doesn't matter. And if it does invert and the leading economic indicators are negative, then it's merely a redundancy. See my point? Okay. So that said, what are the other leading economic indicators stating? So a couple things. One is that if you look at, because this was really on my mind. I was like, okay, the yield curve's inverted. What are the indicators saying about the economy? So a couple things. One is housing starts is one of the best predictors of a recession. If you go back to 2006, you'll find that housing starts had been in basically a nice steady decline from 2006 all the way until 2008. We had basically 2 years of declining data, which was a nice warning sign to the economy that we might be slipping into a recession. What are housing starts doing right now? They're positive. So, in fact, they're positive dramatically. They're up 9.6% from a month ago. So again, if the inverted yield curve was a sign of terrible things, wouldn't we also see housing starts declining? The other thing, and we used to study this at the consulting firm that I worked at right out of grad school, is industrial production can also be a pretty powerful predictor of where the economy is going. And right now, industrial production is positive. The other one, and this is a big one, is employment data. So I know that employment is softening, but I don't think employment data is necessarily bad. So, by the way, employment, we added another 142,000 jobs in the last report. So again, if the economy was deteriorating, if we were worried about a recession, we should start to not just see a softening in employment data. What we should be seeing is an actual outright decline in employment data, and we should see people basically on the unemployment lines. And oh, by the way, one of the reasons why unemployment recently went up was because we had a huge surge of immigration into the United States, and that caused a lot more people to be job seekers. Because you have to remember, unemployment data is not a helpful predictor of the future. Unemployment data is more of a current indicator. It is not a forward-looking indicator, and one of the reasons is that it's actually just looking at the amount of people that are looking for a job. I think if you talk to any serious economist that looks at forward-looking indicators, they don't look at unemployment. What they look at is employment data, which is a much, much healthier and clear predictor of where the employment market is. Because I think unemployment can get skewed because if all these additional people are looking for jobs, then that can raise the unemployment rate. And that's because they were on the sidelines. Now they're looking. That doesn't mean that the actual underlying economy or the employment economy is actually deteriorating. So again, we've got all these leading economic indicators that are positive. I will say this. There's another thing called the Purchasing Managers Index, and that has been below 50. So anything above 50 for the PMI means that the economy is growing. Anything below 50 means that the economy is contracting. The PMI has been below 50 for a while. So that is one, I would say, mixed bag analysis is regarding the Purchasing Managers Index. All right, one other thing, and I got a little bit of heartburn as I was preparing for this episode, was I went to and I'm going to show this to you because I want you to feel some of my anxiety right now. So I went to the conference boards, and I'll show it. So I went to the Conference Board Leading Economic Indicator Index, and basically, let me show you this chart and explain what you're looking at. So there's the blue line is basically an aggregation of a bunch of leading economic indicators. There's a bunch down here, things like new orders, permits, housing, average weekly hours. It does throw in, yield curves and the S&P 500. So one of the things that it'll show is, so if you aggregate all these leading economic indicators, with the blue line, you should see an upward trajectory. And at a certain point, if you start to see the line decelerate or move downward, that could be a sign that a recession is starting to take hold. Now, let's go back to 2008 and 2009. And this is what gave me heartburn in the lead up to this episode, is if you go back to, say, later 2005, this index was starting to decline, and then it really declined pretty significantly. And then we fell into the worst recession in our lifetimes. So I'm looking at this going, all right, does this mean that we are now on the verge of a big recession? And this is starting to look, eerily similar to what happened to 2008 and 2009 with that financial crisis. But my instincts as I was looking at the chart was like, there's something wrong with this because I see too many other indicators that are positive. So why is this looking so negative? And then I actually found an interpretation on their website. So I'm actually going to unshare and then I'll read this to you. So let me read this real quick because I think this provides greater context. So this is what they said. They're contextualizing their data. Incoming data over the last month continue to suggest that the U.S. economy is likely not in a recession or on the cusp of one. Real GDP is expected to rise by 2.4% year over year in 2024. Nonetheless, the economy is expected to lose momentum in H2 2024 as high prices and elevated interest rates sap domestic demand. This will provide lower momentum heading into 2025, which may constrain growth in that year to just 1.7% year over year, despite expectations of stronger quarterly annualized growth as the year progresses. So here's the deal. They're basically just saying the economy is weakening, but it is not. I mean, they say it outright that the economy is not on the cusp of a recession. I think this is encouraging. And so, again, you can look at data, you can look at charts, and you could look at trends. But when you contextualize the data, the charts, the trends, the way I tried to contextualize, say, the inverted yield curve today, what you can find is that oftentimes the narrative of the story is very, very different, which is one of my frustrations with economic data. People glob onto one negative piece of news and they extrapolate it and they try to scare people into thinking that we're on the verge of a great crisis when there isn't enough deeper contextualization of the numbers. So it's interesting that the conference board, when you look at, like I said, when you look at the chart, it almost looks like we're heading into recession, but their analysis suggests something quite different. And the other one that analysis I've been tracking is with Goldman Sachs. So Goldman Sachs does a prediction on if they think a recession is on the horizon. Their prediction was a 15% chance of recession over the next 12 months. Because we did see an uptick in unemployment, they did raise their recession probability up to 25%. It's still really low, though. So there's still a 75% chance that we don't hit a recession. So what does this mean for you if you're an investor? Despite the negativity, despite the bad news that you're hearing constantly in the media, I think you need to remain very focused on your long-term goals. And I think over the next 12 months, and I don't have a crystal ball, but I don't see a recession happening from now through the next 12 months. By the way, anything can change on a dime. I'm not a wizard, and I'm not Gandalf here. I don't know the future, but what I can tell you is that based on what I see now, I don't necessarily see a recession brewing. I do think, though, one day, because I know a lot of you are thinking, yeah, Drew, but the Fed printed all that money. Congress is spending all this money they're doing all these giant spending bills and we're racking up the national debt and that's got to come to a head. I agree with you. That's probably one day going to come to a head. We probably will hit a significant recession. And I think it's possible we could hit one in less than 5 years. But more people lose money, and a lot of people have pointed this out, but more people lose money preparing for an impending recession than if they just went through the recession itself. And so I really caution against becoming Chicken Little with your portfolio and with your investments, and I would encourage you to stay focused on the long term, especially when there's not enough supporting data to suggest that the economy is completely coming off the rails. Now, I don't think the economy is perfect. I think inflation remains a problem, but I'm not prepared to get overly dire right now. I do think as we move into 2026 and maybe into 2027, I wouldn't be surprised to see the probability of a recession rise, but I think you should remain focused on the long haul. Now, a couple more things before I wrap up this episode. And There are just some short-term problems, though. And one of the questions I get asked all the time is, what about the election, Drew? So look, this is like, we live in a very polarized world. The right and the left, listen, mom is not talking to dad in the United States right now, and they're sleeping in separate bedrooms, and we are hyper-polarized. I do think there will likely be a fair bit of social unrest regardless of who wins the White House here in about a month. So I want you to be prepared as an investor that there will likely be some sort of social unrest. And it makes me think of the riots we saw with Black Lives Matter, or the unrest with January 6th. And so I don't think it's going to be clean or easy. And because there's a likelihood of that unrest, it's probably going to create short-term market volatility. In fact, if you go back to when Donald Trump won in 2016, the futures markets were dumping pretty dramatically when the election was being called for Trump. When it looked like it was pretty obvious he was going to beat Hillary Clinton, the futures markets were diving pretty dramatically. But by the next day, and I remember waking up, super early in the morning and barely getting any sleep. I remember getting to my computer and pulling up, the S&P 500 index, and when the markets opened, they went straight up. So there was an amazing amount of volatility, even in like a 12-hour period when we were trying to figure out who the next president was going to be. I do expect markets to be super volatile. When I say super volatile, I expect some degree of gyration in the stock market. I wouldn't be surprised if the market moves 5 to 10% from now until November, but that is short-term noise. Listen, we always get new presidents. They always take office. There's always a transfer of power, and eventually the markets ignore it, because regardless of who's in the White House, okay, you might need like a mental health day on Wednesday, depending on whose candidate is which horse is your horse. But you're probably going back to work on Monday. Maybe you skip out on Wednesday, Thursday, and Friday, but I know you're going to be back in the office on Monday. The world doesn't stop spinning because of a new president. And so I would really encourage you not to worry too much about who's in the White House in terms of short-term economic impacts. I do think it can lead to long-term economic impacts based on the policies that a new administration can bring about. But it's going to take a couple of years for those policies to actually get implemented, be put into law, and be enforced as law. And so there is a major lag effect. Even if you don't like the president, even if you think the person could do economic policies that are harmful to the economy, do remember that there's probably a couple-year lag effect of that playing out. Traditionally, the stock market has done double digits in the 12 months after an election has occurred. A couple of exceptions, 2008 and 1932, those were not good years for the stock market because, as you know, 1932 was basically the middle of the Great Depression. In 2008, Barack Obama was walking into a presidency with the worst housing collapse since the Great Depression. So it has little to do with the president, it had all to do with the economic backdrop. Again, this is all to do with the economic backdrop. It has little to do with Donald Trump or Kamala Harris. And I would encourage you as an investor not to get too wrapped up and worried about this. I bring this up because I'm asked this almost every single day if I'm worried about the economy because of the upcoming, or worried about the stock market because of an upcoming election. And I just don't put a lot of stock into that because there's no historical precedence for the stock market to do poorly just because a new person got elected. Two other things that could provide short-term problems. One is that oil prices are starting to spike. So because of the geopolitical tensions that are growing with Russia and Ukraine, also growing tensions with Israel and Hezbollah and Hamas, and the likelihood that there's conflicts that are starting to spread even to Iran. With that growing geopolitical uncertainty, this will likely push up oil prices, which could push up inflation a little bit. So that is something I think to keep your eyes on. I do think this is a shorter term problem as well, like the election. I would not let this drive lots of fear over the economy over the next 12 months. And then the third one, and this is the last one, is there's been this big worker strike. So port workers, the folks that operate the cranes that get the crates off of cargo ships, they're not working today. And they're not working in the foreseeable future. So they're on strike because they want a pay raise. And they also want The union is demanding that they prevent any sort of automation with the cranes and the port workers. Listen, there's some real cost to this that we should be aware of. With this worker strike, and by the way, it's going all the way from Texas up through Maine. So all of us on the Northeast and down through the Southeast, this is going to affect our ability to gain access to products. And the JP Morgan actually estimated that the cost to this is going to be somewhere between $3.8 to $4.5 billion to the economy every single day. And so I think this is likely going to lead to a quick resolution. I think it'll be painful. And listen, if it extended for a longer period of time, yeah, this could trigger a recession. But this is something that can be resolved and will likely be resolved. So I'd be surprised. I think by the time this recording's out, this is probably this situation should be resolved. But those are events, though, because if you look at the S&P 500 and the NASDAQ, they're both down a lot today because of some of the fears that I just mentioned with oil prices and the worker strike. All right, everyone, I hope that this economic update was helpful to you. I will be back next week with more content. Again, this is Drew Benson and the Benson Wealth Podcast. If you've enjoyed this content and you're looking for a wealth advisor, or if you're a financial advisor and you're looking to make the jump to the independent side, please message me on LinkedIn. Or you can email me at drew.benson@bensonwealthmgt.com. Or lastly, you can call my office at 603-316-2544. Securities offered through Raymond James Financial Services, Inc., member FINRA, SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Benson Wealth Management and True North Wealth Management Group are not registered broker-dealers, and they are independent of Raymond James Financial Services. The foregoing information has been obtained from sources considered to be reliable, but we do not guarantee that it is accurate or complete. It is not a statement of all available data necessary for making an investment decision, and it does not constitute a recommendation. Any opinions are those of myself and not necessarily those of Raymond James. Expressions of opinion are as of this date and are subject to change without notice. There is no guarantee that these statements, opinions, or forecasts provided herein will prove to be correct. Investing involves risks, and you may incur a profit or loss regardless of strategy selected.